Right now, the average savings account in America is paying just 0.61%. Inflation is sitting at 3.8%. That difference, 3.2 percentage points, is not some tiny statistical detail. It is the hidden cost ordinary Americans pay each year for doing what they were told was financially smart. On $50,000, that gap quietly destroys around $1,600 annually in real buying power. Not because of a stock market crash, not because of poor timing, because you trusted your bank to hold your money, and the bank profits from that trust every single day. Roughly $10.6 trillion currently sits inside American savings and checking accounts. In 2025 alone, the banking industry reported $295.6 billion in net income, a 10.2% increase from 2024. Where did those profits come from? Banks take your deposits and issue loans tied to mortgage rates, auto financing rates, and credit card interest. They loan your money to consumers, companies, and home buyers at dramatically higher rates than what they pay you. Most major banks currently offer around 0.01% on savings balances. At the same time, they are collecting 7% to 8% or more on the loans funded by your deposits. That is not some secret scheme. That is exactly how banking works. And things are about to become even more complicated because three major developments happened simultaneously. The Federal Open Market Committee unanimously approved revisions to its statement on long-run goals and monetary policy strategy. Those changes reflected lessons learned from the economy during the past 5 years. Jerome Powell stepped down. Kevin Warsh was confirmed as the next Federal Reserve Chair in a 54-45 vote. President Donald Trump has openly stated that he expects Warsh to reduce interest rates. And the phrase Warsh used to describe his plans, regime change, is not language central bankers normally use. When the person responsible for the price of money across the entire economy starts using wording like that, it is worth understanding exactly what he means. I have spent more than a decade building companies while working closely with accountants and tax attorneys who taught me how money truly moves behind the scenes. A meaningful portion of my own money is invested too. I have real exposure, not theoretical opinions. I spend time reading the dull financial documents, so you do not have to. This video is the version of those documents that actually matters to regular people. Here is what I am going to break down. First, the Fed introduced a revised monetary policy framework during the Jackson Hole gathering in August 2025, and almost nobody explained what that actually means for how long rates may remain elevated. Second, interest rates are trapped in a strange middle ground where inflation is too high for cuts but the economy is too fragile for hikes, and that middle ground creates a very measurable financial cost every single day you ignore it. Third, the new Fed chair has proposed structural changes that will influence Treasury yields, CD rates, and the entire behavior of the yield curve. And the consequences are far more complicated than the simple Warsh equals lower rates equals good news headlines you have probably seen. The opportunity window surrounding all of this will not stay open forever. I will show you exactly why. Think about the Federal Reserve like a thermostat inside a massive house. The house represents the economy. The thermostat controls one thing, the temperature. Turning the heat up means lowering rates, which stimulates economic activity. People borrow money, spend money, and invest money. Sometimes the house becomes too hot, which is inflation. Turning the temperature down means raising rates, which cools everything off. Spending slows and inflation eases. But if rates go too high, the pipes freeze. That is recession and unemployment. For about 15 years before the pandemic, the Fed kept fighting economic cold. Interest rates constantly drifted towards zero. Inflation repeatedly stayed below 2%. The Fed tried again and again to warm the house and repeatedly failed. So in August 2020, they installed a different kind of thermostat. They called it flexible average inflation targeting. Complicated phrase. Simple meaning. If the economy had stayed cold for a while, the Fed would intentionally allow inflation to run hotter before responding. They deliberately allowed inflation to rise above target for a period of time. The reasoning was straightforward. We spent years battling weak inflation, so we need protection against undershooting. Powell explained at Jackson Hole that during the previous review, the Fed operated in a new normal defined by interest rates near the lower bound, combined with slow growth, low inflation, and a flat Phillips curve. Later, Powell admitted that the idea of intentionally allowing a moderate inflation overshoot ended up being irrelevant. There was nothing moderate or intentional about the inflation surge that arrived shortly after the 2020 policy changes. Then, in August 2025, they quietly replaced that thermostat. Keep the thermostat comparison in mind through this entire video, because when you examine what is happening to your savings right now, you are really examining who controls the dial and what temperature they want to maintain. Stay with me because the current setting is stranger and more expensive than most people realize. The FOMC continued debating policy changes during its July 2025 meeting, eventually approving a revised statement on long-run goals and monetary policy strategy. The updated statement became public on August 22, 2025. There was no major announcement, no televised speech, no dramatic headlines. It was simply a revised document which explains why almost nobody noticed it. Here is the important part. By March 2021, inflation had already climbed above the Fed's 2% target. Yet the Fed waited an entire year before raising rates in March 2022. Economists have spent years asking how much the earlier framework contributed to that delay. Looking back, the answer appears to be quite a lot. The framework gave the Fed permission to remain patient, and it exercised that patience at the worst possible time. Aggressive rate increases between early 2022 and mid-2023 eventually pushed core PCE inflation down from more than 5.5% year over year to around 3.0% by February 2026. The Fed's 2025 framework review heavily reflected what happened after the 2019 to 2020 policy review, especially the fact that inflation remains above target. However, the updated framework is not simply a return to the old system. While the sections that arguably favored higher inflation were removed, the revised statement now places stronger emphasis on inflation expectations and is arguably more flexible across different economic conditions than older versions. During the May 2025 FOMC meeting, participants agreed it made sense to reconsider the average inflation targeting language. Officials stated that a successful monetary policy strategy must function across many different economic environments and viewed flexible inflation targeting as more capable of correcting inflation that drifts too high or too low relative to the Fed's 2% goal. Translation: the previous strategy basically said, allow inflation to run hot and we will catch up later. The new strategy says inflation deviations on either side deserve symmetrical responses. The built-in bias toward tolerating higher inflation is gone. The thermostat no longer leans warm. It now reacts to overheating the same way it reacts to cold conditions. Why does that matter specifically for your savings account? Because the previous framework quietly implied the Fed would move slowly against moderate inflation increases, giving savers more time to benefit from elevated yields before rates eventually declined. That implied protection no longer exists. With policy rates already close to neutral, there is limited room for cuts in 2026, especially with rising energy costs, continued pressure on core inflation, and global commodity risks delaying progress toward the inflation target. But here's the twist, and this is the major reversal most people miss. You think the main issue is that inflation is too high. Yes, 3.8% inflation is uncomfortable. But for most savers, inflation itself is not the central problem. The real issue is that inflation remains high enough to block rate cuts, while not being high enough to force more rate hikes, so rates become stuck. And when rates stay frozen during inflationary periods, the purchasing power of your cash slowly erodes month after month on a schedule completely unrelated to your personal finances. There is a name in finance for money that quietly loses value while sitting still. It is called dead money. According to Bankrate's survey on May 22, 2026, the national average savings account yield sits at 0.61% APY. Meanwhile, the best high-yield savings accounts are paying around 4% APY. Most American savings are sitting somewhere between those two figures, far closer to the dead money side than people understand. In a few minutes, I will explain what the new person controlling the thermostat has said he wants to do, and why the lower rates are coming narrative is far too simplistic. But first, you need to see the actual math behind this dead money environment. Because once you see the numbers, they quietly force you to rethink your priorities. Meet Marcus. He is 47 years old and works as a civil engineer in Columbus, Ohio. He earns a solid income. Over many disciplined years, he managed to save $85,000. He keeps the money at Chase because he opened the account during college, and that relationship survived 3 moves, 2 vehicles, and 1 divorce. Marcus is not irresponsible. He genuinely believes leaving cash in a savings account is the safe, sensible adult decision. Chase currently pays Marcus 0.01% on his $85,000 balance. That equals $8.50 annually, not monthly. Annually. At the same time, Marcus could open a high-yield savings account at several online banks and earn around 4.1% on that identical balance. That would produce roughly $3,485 each year. The difference between those two outcomes is approximately $3,477 annually on the same $85,000 sitting inside the same FDIC-insured banking system with essentially identical legal protections and withdrawal access. The only thing changing is the website tab he clicked. The average American keeps the same brick-and-mortar banking relationship for around 18 years. According to Bankrate's latest checking account survey, 18 years of earning near 0.01%, while forfeiting roughly $4,000 per year in potential interest, adds up to about $72,000 in missed earnings before inflation, and before considering what investing those earnings could have compounded into. Banks understand this dynamic perfectly. Traditionally, banks raise deposit rates when they need more deposits to fund loans or satisfy liquidity needs. But when deposits are plentiful and demand is weaker, especially during relatively stable economic conditions, banks feel far less pressure to compete. The Federal Reserve stopped raising interest rates in 2024 and later began cutting them. Without competitive pressure, banks had little reason to aggressively raise savings yields. Your loyalty becomes their advantage. Your inaction strengthens their balance sheet. Here is where things become truly interesting, and where most people misunderstand what is happening. High-yield savings accounts are not becoming bad. They are becoming normal again. The 5% plus savings rates during 2024 and 2025 were historically unusual, and their decline was always likely. Accounts paying 5.25% APY in early 2025 have already fallen into the 4.50% to 4.75% range, and additional declines are highly likely. By the end of 2026, the strongest high-yield savings rates will probably sit somewhere between 3.5% and 4%. Now, do the after-tax math, because almost nobody bothers to. And that is precisely why this matters. Inflation was running around 3.2% in early 2026. At a 3.75% savings yield against 3.2% inflation. Your inflation. Adjusted return is only about 0.55%. Then taxes reduce it further. Apply a 22% federal tax rate to a 4.1% HYSA yield, and your after-tax return drops near 3.2%. Against April CPI inflation of 3.8%, your real after-tax return becomes negative 0.6% annually, even in the best savings accounts currently available. This is not an argument against using a high-yield savings account. You absolutely need liquid emergency savings, and that cash should sit there. But it is an argument against treating a savings account like an investment strategy. It is a conversation about sizing your cash correctly because the last 2 years of unusually high savings yields created a dangerous psychological habit. Excessive cash hoarding disguised as responsibility. When savings accounts outperform long-term bond averages, holding large cash balances feels intelligent. But as rates normalize, the performance drag from too much cash becomes increasingly expensive. Historical Morningstar data shows investors holding more than 20% of their portfolios in cash consistently underperform balanced portfolios by roughly 2 to 3 percentage points annually over 10-year periods. Emotional comfort carries a measurable financial price. On a $200,000 portfolio, that 2 to 3 point annual gap over a decade equals somewhere between $40,000 and $60,000. Not from fees, not from market crashes, just from the slow, invisible cost of holding too much cash when the math no longer justified it. The thermostat froze the room at a temperature where savings accounts look productive while quietly losing purchasing power underneath the surface. That difference between nominal safety and real safety is one of the most consistently misunderstood concepts in personal finance. By the way, subscribe if you enjoy this kind of content. Otherwise, the algorithm may never show you another one of my videos again. Here's the part nobody includes in articles about savings rates. Understanding that high-yield savings accounts are losing purchasing power after inflation and taxes, realizing the current rate window is shrinking, and recognizing your cash allocation is probably too large. That is the easy part. The difficult part is building a real system around that knowledge. Knowing what to do and actually doing it are completely different things. I created a digital book called The Exit Code. It contains 8 chapters of pure research, condensing 50 years of retirement data into a mathematical framework for figuring out when you can stop trading time for money. No fluff. 2 sections connect directly to everything we are discussing here. The first is something I call the 4% trap. Conventional retirement advice says you can safely withdraw 4% from your portfolio annually during retirement. But that rule was created during a very different inflation and interest rate environment than the one we face now. In a world where real yields on safe assets are near zero or negative after taxes, the traditional 4% rule needs to evolve into a dynamic withdrawal strategy that adjusts based on actual market and rate conditions. The book explains exactly how that system works. The second section covers the lazy portfolio, a historically tested asset allocation strategy that has outperformed many active managers over 30-year periods, simply by staying properly positioned and ignoring noise. It directly addresses what should replace excess cash once your savings balance is properly sized. You can grab it through the link in the description for less than the price of a restaurant dinner. The arithmetic behind waiting is simple. Every year you delay building a proper system, you compound against yourself. Not fake urgency, just math. Kevin Warsh officially became the next Federal Reserve Chair in a 54-45 confirmation vote on May 13, 2026. It was the most politically divided vote for a Fed chair nominee in American history, reflecting Democratic concern over Trump's ongoing battle with the Fed. Republicans generally supported Warsh's appointment. Warsh's first FOMC meeting as chair is scheduled for June 16th and 17th. When Warsh leads that first meeting, he may face something no Fed chair has dealt with in more than 75 years. His predecessor still sitting in the room. Powell's term as chair ended on May 15th, but his term as a regular Fed governor continues until 2028. Normally, former Fed chairs leave entirely after stepping down. In practical terms, the man who controlled the thermostat for the last 8 years still has his hand near the dial. During the April meeting, 4 of the 12 FOMC voting members dissented against either the rate decision or the policy statement, marking the committee's deepest division since 1992. That kind of disagreement does not instantly disappear because a new chair arrives. By mid-May, markets were pricing in largely unchanged rates through the end of 2026, with less than a 3% probability of cuts during any remaining FOMC meetings this year. Markets are effectively saying Warsh inherits a frozen system he cannot easily unfreeze. Here is the important part. Warsh has repeatedly stated, including during his Senate confirmation hearing, that he is not simply a cut rates immediately person. He has instead called for a broader regime change in how the Federal Reserve operates. He criticized how frequently central bankers communicate forecasts and hinted at reforms involving everything from the Fed's balance sheet to banking regulation. When senators pressed him on the phrase regime change, Warsh clarified he meant changing the policy regime, not replacing personnel. In other words, he wants to keep the people but change the way they think. That may actually be harder. The incoming Fed chair has floated or suggested reducing the Fed's $6.7 trillion balance sheet, coordinating more closely with the Treasury Department, reducing annual policy meetings from 8 to possibly 4, holding fewer press conferences, shrinking the Fed's Washington workforce, and offering less guidance about future interest rate paths. Every one of those proposals carries consequences for your savings and investment strategy. Let's walk through them. Fewer FOMC meetings means slower moving policy responses. In an environment where inflation remains above target, that usually means rates stay elevated longer between decisions because the Fed has fewer opportunities to adjust. For people holding cash in high-yield savings accounts, prolonged higher rates appear positive on the surface. But if economic conditions suddenly change and geopolitical events can trigger rapid changes, the Fed becomes structurally slower to react. That creates an entirely different category of risk unrelated to savings yields themselves. Warsh has consistently argued for a smaller Fed footprint, less forward guidance, and more market-driven price discovery. These priorities arrive at a delicate moment when Treasury issuance remains high and fiscal concerns are becoming harder to ignore. As of late April 2026, the Fed's balance sheet still sat near $6.7 trillion, more than triple its pre-crisis size relative to the economy. To Warsh, that lingering expansion proves the Fed never fully exited emergency mode behavior. If he accelerates balance sheet reductions, more treasuries enter the open market. More supply with unchanged demand pushes treasury prices down and yields higher. Rising long-term treasury yields would likely support higher CD yields because CDs generally follow shorter-term treasury movements. Reduced communication from the Fed also increases uncertainty, and markets demand compensation for uncertainty through higher risk premiums. For investors, the post-Powell era may be defined less by Fed promises and more by how markets behave, once those promises become less frequent, raising important questions about volatility, yields, and the actual cost of capital in Treasury markets. Here's the practical takeaway. Under Warsh, the yield curve will probably steepen. That means short-term rates stay relatively stable while longer-term yields drift upward. For people positioning cash equivalents, this actually supports locking in current, short-term rates sooner rather than later, because the existence of 4% plus short-term yields depends on today's frozen policy environment, not some permanent new reality. The April 2026 CPI report showed year-over-year inflation of 3.8%, while March PCE inflation measured 3.5%. Meanwhile, the April 2026 employment report showed unemployment steady at 4.3%, close to the Fed's long-run unemployment estimate and suggesting inflationary pressure from strong demand remains elevated. Then there are energy prices. Conflict with Iran and tariffs imposed by Trump last year have added additional inflation pressure, driving headline inflation to the highest levels in nearly 3 years. Oil prices have surged more than 60% since late February, leaving the Fed stuck in a wait-and-see position as it balances employment and price stability. The thermostat now has a new operator, political pressure behind him, geopolitical shocks ahead of him, and a divided committee surrounding him. The temperature inside the House is unlikely to change quickly. Former Fed Chair Janet Yellen recently stated that she does not believe the FOMC will quickly embrace Warsh's agenda. That quote matters because it suggests the dramatic rate cuts Trump publicly wants, including comments about rates as low as 1%, are nowhere near consensus. Professional investors, institutional money, and financial markets pricing these outcomes in real time currently expect 0 cuts before year-end. Meanwhile, Marcus in Columbus is still debating whether to open that new savings account tab. Here's the framework. 3 buckets. Get these 3 buckets right, and you will already be ahead of most people financially. Bucket 1 is genuine emergency liquidity. 3 to 6 months of expenses, not income expenses. If you spend $4,000 monthly, you need roughly $12,000 to $24,000 accessible within 24 to 48 hours. That money belongs inside a high-yield savings account, at an online bank. Not because rates are amazing, because after inflation they are not. But because FDIC insurance is identical to traditional banks, access speed is basically identical, and the yield difference is enormous. Competitive online savings accounts still pay around 4%, APY more than 400 times the typical 0.01% offered by major banks. On $20,000 in emergency cash, the gap between those yields equals about $798 annually. There is simply no rational reason to ignore that difference. Bucket 2 is medium-term money. Funds you know you will need within 1 to 5 years, but not immediately. Down payment savings, a major expense, a car purchase 18 months away. That money does not belong in a standard savings account, and it does not belong in stocks. It belongs inside a CD ladder. Current 12-month CD yields range roughly between 4.25% and 4.75%, with certain credit unions still offering promotional rates above 5%. 2- and 3-year CDs are yielding around 4.0% to 4.5%. A CD ladder means dividing money across multiple maturity dates. Some CDs mature in 6 months, others in 12 months, others in 18 months, others in 2 years. Whenever one matures, you reevaluate. If rates fall, you roll into the best remaining option. If rates rise, you benefit from improved yields. Your entire medium-term cash reserve never gets locked up simultaneously. If rates continue drifting lower, CDs may decline too, which is exactly why some savers prefer locking rates in now through ladder structures. CD ladders are not exciting. They are simply effective. Bucket 3 is long-term capital, money you will not need for at least 5 years. That money does not belong inside a savings account. Period. Not at 4%, not at 5%, not at any bank yield. Because over any 15 to 30-year period, the compounding advantage of equities over savings vehicles becomes so overwhelming that the math is barely debatable. Here is the actual example. $100,000 compounding for 30 years at the national savings average of 0.61% becomes about $120,100. The same $100,000 compounding at 4% for 30 years grows to roughly $324,300. That difference is over $204,000. $204,000 lost simply by choosing the safe option over 3 decades. And historically, the stock market has produced returns well above 4% across every rolling 30-year period in modern history. You think investing is the risk. The data suggests avoiding investment is the bigger risk.